Hi, this is Nick here and about to go through the updated chart book on the U.S. equity market. So this chart here giving us a big picture, longer term outlook. No change from last month's report. If history is any guide, this chart suggests that the S&P 500 return without dividends might be close to 0% over the next 10 years. Then moving on to the business cycle backdrop, so the leading economic indicators index, which is the gray line here, continues to generally trend higher, which historically is supportive of stocks. Then the earnings backdrop, so very strong Q1 earnings. The Q2 earnings are just starting to come out. So far, 5% of companies reporting results for the quarter. 89% of them have reported positive earnings surprises, and 85% have reported positive sales surprises. So we'll see how the rest of the year goes in terms of earnings. What would get me negative here is to see this gray line sort of trending sideways to down over a 2-quarter period. Then the global growth backdrop. So we've had, global manufacturing PMIs kind of trending sideways, but still above 50. Then on U.S. financial conditions, so financial conditions tightening a little bit here, a little bit tighter than last month's report, and the key threshold that I'm looking for here is to see this gray line cross below this negative 0.50 line. Then in terms of market breadth, so this chart doesn't get updated unless we're at a new bull market high, so this is visually providing the same view that you've seen in previous monthly reports and videos. But just a reminder that the last all-time high for the S&P was January 26th. The breadth reading was very strong at that high and not historically consistent with a major market top. Then in terms of sentiment, so the AAII bulls bearish sentiment reading percent that are bullish is at 60. That's pretty much in line with the long-term average, so a neutral interpretation here. Last week it was down at 41%, which was a pretty weak sentiment reading, and this is I view this as a contrarian indication that when others are bearish, it's better to be bullish. And I think that there's been a lot of weak sentiment on the trade war fears, and maybe that's starting to fade a little bit. That's obviously still a big question mark. Then in terms of margin debt, so the margin debt relative to the market really hasn't moved much. This is not something that I would say is necessary to get negative on the markets, but obviously if I did see a buildup of margin debt relative to the market, that would be a warning sign. All right, then in terms of the correlation and volatility picture, so you can see here that the correlation, and this is the average correlation between the 10 GICS sectors and the overall S&P 500 index, has been declining again recently, and that may be supportive of stocks as that tends to reduce the overall risk as measured by standard deviation of being invested in the S&P 500. All right, then the uncertainty index. So this uncertainty, the gray line here falling means higher uncertainty, and I think that may have been falling in part, or uncertainty rising in part based on the headlines around the trade war. Now, what that does do that's positive is helps create a wall of worry to climb. In other words, the market may rise on the back of the falling uncertainty as those trade war fears subside, which they may or may not do. That's not necessarily a forecast. It's just the potential is there for the market to rise on that falling uncertainty. Then the Vix curve here, so this is positively sloped, which is generally a positive sign for stocks. This is basically a trend following indicator. Then I think this is a new chart for this release, but it's I guess you could call it a technical picture. These are the open, high, low, close bars for the S&P on a daily basis, and then the gray line is the 50-day moving average. The black line is the 200-day moving average. One of the main indicators, sort of medium to longer term indicators that technicians look at is seeing this gray line cross below the black line, so the 50-day moving average crossing below the 200-day moving average could be a negative sign for stocks medium term. What I'm noticing here is that we are, in a sense, making higher highs and higher lows since the beginning of May, and on Friday's close, the cash market closed just above 2,800, which I think is potentially an important psychological level. And technicians generally regard the Friday close as the most important price of the week because it doesn't have the intraday and intra-week traders essentially affecting the market. It's the balancing of liquidity or the balancing of order flow between longer-term holders of stocks. All right, then to just check in where we are year to date. So the S&P 500 is up about 4.8% here year to date. Coming into the year, the forecasts were for a return between 0 and 10% for the year. So we're right in the middle of that right now, but still have about half of the year left to go. Here's the overall assessment of the market. So a number of I guess mixed characterizations here, but to summarize it, mainly it's positive on the short to medium term and negative on the medium to long term. And you can see that here in the overall characterization with the various levels of uncertainty. Of course, this is on a sort of a base case scenario basis that I express these characterizations. All right, let me leave it there.